best artificial intelligence model you can buy today scores 63 on the industry's headline benchmark. The fourth best scores 61, 2 points. That is the entire gap between the frontier and the chasing pack. Now here is the number that should actually stop you. The model scoring 61 costs more than 60% less to run than the one scoring 63. And on the very same day that comparison became public, the company holding the 63 was reported to be in talks to spend $6 billion, the largest acquisition it has ever attempted, on a business that does not build models at all. It makes chips run cheaper. So this video is about one question. If the smartest model in the world is worth 2 points and a 60% premium, what exactly is anybody selling? Let me set the table. Yesterday, a model called Grok 4.6 was released, and it landed directly at the frontier of the industry. Not near it, at it. On the Artificial Analysis Intelligence Index, which is the closest thing this business has to an agreed scoreboard, it scored 61 points. That ties it exactly with GPT-5.6 Sol, which was until that moment considered one of the 2 or 3 most capable models on Earth. Above both of them sit 2 models from Anthropic. Claude Opus 5 at 63 and Claude Fable 5 at 62. So the top of the table now reads 63, 62, 61, 61. 4 models, 3 points, 4 different companies. That is not a leaderboard. That is a traffic jam. Sit with the shape of that for a second, because we have all been trained by 3 years of headlines to expect something else. We were told this would be a race with a runaway winner. Enormous capability gaps. One lab pulling so far ahead that nobody could catch it. And instead, the distance between first place and fourth place is 2 points on a 100-point scale. If 4 car companies all built a vehicle that did 0 to 60 within a tenth of a second of each other, nobody would call that a technology race anymore. They would call it an industry. And industries do not compete on genius. They compete on price. Now let me back all the way up, because if you have not been swimming in this world, those numbers are just noise. So 2 things you need. First, the Artificial Analysis Intelligence Index is an independent composite benchmark. It runs models through reasoning problems, general knowledge, mathematics, and coding, and rolls the results into a single score. It is not perfect, no benchmark is, but it is public, it is consistent, and the whole industry quotes it. And I say 63 versus 61, that is the number everyone in the field is looking at. Second, and this is the important one, you do not buy artificial intelligence by the month. You buy it by the token. A token is roughly a fragment of a word, and every time a model reads your request and writes an answer, it consumes them. So companies are billed per million tokens in and per million tokens out. That per token price is not a detail. It is the entire economics of this industry. It is the cost of goods for every chatbot, every coding assistant, every artificial intelligence feature quietly bolted on a software you already pay for. Which means when the per token price moves, everything downstream moves with it. So here is the bill. Grok 4.6 charges $2 per million input tokens and $6 per million output tokens. Claude Opus 5, the model 2 points ahead of it, charges $5 in and $25 out. GPT-5.6 Sol, which is tied with Grok on capability, charges $5 in and $30 out. Look at the output column, because that is where the real work happens. $6 against $25. $6 against $30. That is not a discount. That is a different business model wearing the same product category. And there is a second layer underneath it that most coverage skipped entirely. Artificial analysis also measured how efficiently these models actually finish work and found Grok resolving tasks in around 53 turns using roughly 500 million input tokens, against about 103 turns and 2 billion tokens for the top Anthropic configuration. So the cheaper model was also, in that test, doing the job in fewer steps. The cost advantage compounds well beyond the sticker price. Now, if the story ended there, it would just be a good week for one company and a bad week for its competitors. Prices fall, consumers win, we all move on. Except something else happened the same day, and this is the part that made me want to make this video. Bloomberg reported that Anthropic, the lab that holds the 63, the actual number 1 on the board, is in talks to acquire a startup called Descartes for about $6 billion. I want to be careful with the language here because it matters. These are talks. The deal is explicitly reported as not finalized, and it could fall apart. But if it happens, it would be the largest acquisition Anthropic has ever made, and roughly its 5th of the year. Descartes raised $300 million back in May at a valuation of close to $4 billion. $6 billion is about a 50% premium on that, 3 months later. What does Descartes actually sell? Not a model, not a research team chasing a higher benchmark score. Descartes makes software that reduces the cost of training and running artificial intelligence by getting more useful work out of the same chips. That is it. That is the product. Efficiency. And the reporting is explicit about the motive, that the acquisition is meant to help Anthropic's existing computing infrastructure absorb more demand as adoption surges. I'll put the 2 events side by side, because together they say something neither says alone. On one side, a competitor arrives at the frontier and undercuts the leader by more than 60%. On the other side, that same leader is reported to be paying a record sum at a 50% premium for cost reduction. not for capability, for cost. The company sitting at number 1 on the intelligence board is spending its biggest check ever on the electricity bill. Right? Let me take the other side properly, because there's a real case against everything I have just said. First, benchmarks are not products. A 2-point gap on a composite index can still mean a meaningful difference on the specific task you care about, and plenty of engineers will tell you the top model feels different in ways a score does not capture. Fair. Second, price is not the only thing enterprises buy. They buy reliability, safety tooling, contracts, support, and the confidence that the thing will still be running in 3 years. Cheap does not win procurement on its own. Third, and most reasonably, buying efficiency ahead of scale is just good business. If demand for your product is exploding, buying the ability to serve more of it per chip is a growth move, not a defensive one. Every one of those points is legitimate, but notice that none of them argue with the actual observation. The gap in capability is 2 points. The gap in price is more than 60%, and the leader is paying a record premium for cheaper compute. You can dispute what it means. You cannot really dispute that it happened. Here is where it stops being a technology story, because the exact same shape showed up somewhere else today. This morning, the producer price index came out. Over the last 12 months, the prices businesses pay rose 4.7%. Over that same period, the prices consumers pay rose 3.4%. That gap, more than a full percentage point, is companies absorbing costs they cannot pass on. It does not appear as inflation. It appears quietly, quarter or two later, as compressed margin. So look at what today actually gave us. In the real economy, input costs rising faster than output prices. In artificial intelligence, near identical capability with the price collapsing underneath it. And if you want the third one, a regulatory proposal to let shares trade around the clock as tokens, with the voting rights and the dividends explicitly stripped out. 3 different arenas, 1 mechanism. The ability to charge more than something costs you is being competed away. Pricing power is the scarcest asset in this market right now, and on a day the stock index printed an all-time high, almost nothing is priced as though that is true. So here is the question I would genuinely sit with. If 4 companies can all reach the frontier, and the 4th one charges a fraction of what the first one does, then who in that chain actually keeps the profit? Maybe it is whoever owns the chips. Maybe it is whoever owns the customer. Maybe, for a while, it is nobody at all. Tell me where you think it lands in the comments. And watch the efficiency deals, not the benchmark scores, because that is where these companies are voting with their own money. This is research and education only. It is not financial advice. I'm Frankie, the asymmetric signal, one contrarian read a day. Subscribe.